You do your analysis, you find the perfect setup, you enter the trade with confidence, and then you watch your stop loss get triggered by literally 2 pips before the market reverses and goes exactly where you predicted that it would go. You have lost money on that trade, and you were actually right about it in the first place. And it keeps happening over and over again. If this sounds familiar, the problem is not your analysis, it is where you are putting your stop loss. And today, I'm going to show you exactly why this keeps happening to you and how to fix it. Alright, so let's get straight to it. Now, when you are about to set your stop loss, of course, you know that your stop loss is not the first thing that comes into your mind. The first thing that comes into your mind is where you are actually taking the trade. But before you actually look forward to taking the trade, there are 3 things I would like you to pay attention to. Number 1 is your reference point. Now, the reference points I make use of are areas like support areas, resistance areas, fair value gaps, order blocks. Alright, so let's do a little bit of example here. Now, let's identify a few gaps. So you can see this is a gap right here. So let's see if we are going to see some other gaps here. All right, so here's another gap. Here's another gap. I want you to pay attention to how the market respects the gap, especially halfway the gap. Halfway the gap. All right, so you can see the market usually respects halfway the gap. Halfway the gap. Alright, so we see that it respects halfway the gap. Now, there are many areas of interest that you could be looking out for. Whether you're looking out for a support or resistance zone, or you're looking at fair value gaps. But let's just look at it from the standpoint of a fair value gap. Remember, the goal is where we are entering the trade. Alright, then we will now begin to look for where we can put our stop losses. Okay, so this is an entry area right there. This is an entry area. All right, but you don't just want to take trades around here and then put your stop losses far away and just hope that the market goes in your favor. No, you don't just do that. What you want to do instead is to pay attention to what I'm about to show you. All right, now I want you to pay attention to this area. We'll call it a low. Now your stop losses have to go below a low if you are in a buy trade, and has to go above a high if you are on a sell trade. Now the question is, do I buy here and put my stop loss below and then put my take profit above? Today we are not talking about take profits, right? All right, so do I put my stop loss below here and then my take profit just above here? What are the conditions? What are the things that I need to look out for to be sure that this market has the possibility or does not have the tendency of coming back down here? Now, this is where we are going to be looking for this kind of pattern. Now, I want you to pay attention to patterns like this. All right, now I don't exactly advise that people take trades around here. Now, while there may be a reason for which you can take a trade around here, maybe this area is a gap and the market gets to halfway that area. If this fits your trading strategy, you can choose to take a trade around here and put your stop loss below. All right, but I want to show you the placement of stop loss that is a lot more better. Okay, a lot more better. So rather than just taking our trades here, we want to confirm that this low is a confirmed area, is a confirmed low. So what do? We want to pay attention to the area, the candles that form that low. We want to see a break out of it. Okay, now for the casual break of structure, this area would have been a break of structure This is what we will consider a break of structure, right? And then we want to see retracement. Whatever suits you, whether a break of structure or what I'm going to be sharing with you, but you want to see at least the market taking out a previous level. So in this case, we see that these candles were the red candles that formed that low, and the moment we see a break out of it, we can be sure that this area is a protected area. So our stop loss going below that area is a good idea. So what do we see? We see the market going upwards, coming back downwards. Now what do we see here? We see the market coming into a gap. The whole of this place is a gap, and if you notice, just like I said, if you just take a trade based off the gap, if you take a trade based off the gap, this would have been your entry, right? For this trade, your stop loss would have been below that area. But if you had done that in this area, this is where your entry would have been here, and your stop loss would have been below. And look at that, you would have been stopped out by this very long wick. So what do I do instead? I look for, remember, this is my reference point, which is the gap. This gap is my reference point, just like this gap was my reference point here. But I'm not interested in taking a trade once the market gets into my gap, right? I want to see that this area, which is the red, multiple red candles that form that low, I want to see that it is broken out from. Okay, so I don't just want to take a trade based off the bullish candle that I see here. I want to see that there is a candle that takes out that high, which is going to be this area here. I want to see a candle that takes out that high. All right, for some people, they can make use of this area, which is this. All right, I always advise that you make use of the line chart. All right, I think it gives a lot more clearer idea when it has to do with the subject of breaking of structure. Okay, so when you see that the market has broken that structure, right, then this area becomes a valid area to take a long position. So you can take a long position maybe around here, or you can go into lower time frames and take a trade around this zone, around this area, after you have seen that the break of structure has occurred. Now the idea, I'm not teaching a strategy here, I'm just showing you how to identify a low or a high that is valid for placing your stop loss. Now, just like this here, this example we have here, until this area is broken out from, we cannot validate that this area is a low we want to be concerned to put in our stop loss. But the moment this is broken out from here, then this low can be a confirmed area to take a trade, and then you can put your stop loss above. All right, for those people who are a little conservative, you can choose to make use of Fibonacci retracement and then target the 50% Fibonacci level, whichever way works for you. But just make sure that once a low is formed, you want to make sure that, okay, like this, once a low is formed, you want to make sure that the candles that form that low is broken out from before you can put your stop loss below. So you don't have to put your stop loss far away. Putting it below is just as good, because you have your area taken out by a candle here. Okay, so let's look at just one more example. Okay, so for this one we have here, we have this here. Now we want to see what area, or what is the candle that pushed the price up to that point. We want to see it broken out from. So in this case, we see that the market got into that gap, and we broke out from here. So this is where the breakout occurred. Okay, so for this is going to be possible, or you can see this clearly on the line chart, right? Okay, if you come to the line candlestick, this is what you are going to see. For the candlestick, we can still consider this area a break of structure, whichever one is fine by you. Okay, if you draw your Fibonacci from that point there to the down below here, you will notice that once the market got into the 50 level, I think at some point it got to the 61 level, you can decide to take your trade once you see this trade. Once you see this candle right there, you can decide to take a short position around here, and then you can say this area, which is the top, is valid, and then you can target whether a risk reward ratio of 1 to 2 or risk reward ratio of 1 to 3, depending on your trading style. All right, so this is how you set your stop losses. So don't just put your stop losses randomly. You want to make sure. Okay, let's look at yet another. So we have this area right here, which is a low, but we cannot confirm that this is a low yet until we see that the candles that made the low, which is all of this here, the red candles that, okay, let me just make it easy, the red candles that form that low, we want to see it taken out. So the moment it is taken out, which is going to be this, then we can confirm that this area is a low. All right, so any trade you are going to take along after the breakout has occurred, whether you take it after a retracement, some people wait for a retracement from that point, you take it high to that point. Some people wait for a retracement towards the 50 level. So if you choose to take a trade around here, all right, don't forget this is based off the 15-minute time frame, right? I've not done the analysis from the from the higher time frame up to the lower time frame. Okay, so this is a little bit will I call it subjective, right? We are focusing on just one time frame. The goal is just to show you how you can set stop losses that are actually cool. All right, so this risk reward ratio is 1 to 2. Okay, from the higher time frame, okay, so this would have been a losing trade. Why? Because we are not looking at it from the higher time frame. Okay, if you go to the higher time frame, maybe the 4-hour time frame or the 1-hour time frame, you will likely see it clearly. Okay, see where we are trying to buy. Let me do this. So you can see that from the higher time frame, we're in a very serious downtrend. So what we saw on the 15-minute time frame was just a little bit of reversal, and so it was bound to fail, right? It was bound to fail because we are trading counter trend. Okay, so you want to make sure that while you are doing this, you are trading in line with the trend. Very important, you are trading in line with the trend. So this is the trend which is going downwards. Okay, so we have had a push upward, downward, upward, downward, and then we are likely going to push upward right there. Okay, so with the idea that we are pushing upward, we can now begin to look for opportunities towards that area, which is this. So let's see if we can find any low. Okay, if we had any opportunity towards that area. So in this case here, we had the market coming. This is the 30-minute time frame. We had the market taking out liquidity here. So we had market taking out liquidity slightly and got into a gap from this low, right? From that low. Now, what candle formed that low? This was the candle that formed that low. So we want to see that the market breaks out of it. So in this case, we see the market breaks out of it at this point right here. So as the market breaks out of it, if you take a trade from here and then you put your stop loss exactly below, you are not wrong. put your take profit 1 to 2. Okay, so this is a valid entry. So far there is nothing as clear as the ones or the examples that we have taken in times past. If you look at all of the examples, you will notice that there were at least 2 different candles here. 1, 2. Okay, this is the 30-minute time frame, right? We come to the 15-minute time frame, you are likely going to see more candles. Okay, so the same thing here, we had multiple candles right there. Okay, so this case also, all right, so in this case also we saw this push down, push up. We saw this candle that formed that low. It was taken out at this point. We had a little bit of retracement and then we pushed higher. So this is exactly how you can set your stop losses. This is exactly how you can set your stop losses. Okay, you want to make sure that the area that forms a low, I think you want to make sure that the area that forms a low, just like this you're seeing here, the area that forms a low is broken out from. The moment it is broken out from, then you can now begin to look for opportunities, and then this area becomes a valid area for your stop loss, while you can target a risk reward ratio of 1 to 2. All right, so that's just how it works. It's just as simple as that. So rather than having your stop losses too far and having your risk reward ratio a little lesser than it should, you can just avoid putting your stop losses far by this knowledge that you have been able to acquire. Okay, so we can see yet another example here. The market takes out liquidity right there. If you have not watched the video on the only so if you have not watched the video I talked about, I think this video you can see on the screen, please do well to see it. Okay, I talked about candlesticks like this. So what do we see? We see the market tapping into a fair value gap after taking out liquidity somewhere around here. And what are the candles that actually formed this low? This here is a candle that formed this low. So we want to see that the market breaks it right there. Okay, so the market breaks it, and then we did not really get a deep retracement down. What we got here was this was a gap. Okay, we have a lot of gap here. So this was a gap. The market tapped into that gap here, formed a new low, very small, and I would call it not so significant. And then after it formed that low, the candles that that formed that low, you want to see it being broken out from. So we had that break of candle. If you come to the lower time frame, you're likely going to see series of candles on the 5-minute time frame that form that low. So your stop loss can go below that area, because now we have a confirmed low, and then we can target a risk reward ratio of 1 to 2. Okay, so you can use this to fit in any strategy that you are working with. If you're working with a strategy that you trade support and resistance, fine. If you trade fair value gaps, fine. If you trade order blocks, just make sure that this knowledge of making sure that a low is being broken after the low is formed or the high is formed, it breaks out the series of candles that form that low, and then you want to see the market move in that direction of the breakout. Okay, so I think I'll call it a day here, and I'll see you in the next video. If you love this video, do well to subscribe, and if there are any questions at all, do well to put them in the comment section, and in consequent videos I could actually address them as much as I can.